Hello and welcome to another edition of the Friday Market Update. We're glad you're here with us today. We have a lot of information to cover, so it'll be a little bit longer than usual, but here we go. So, have we made it over the last hump of the interest rate roller coaster? I believe we have, and it could be all downhill from here with interest rates. So rates actually climbed above 7.5% midweek and ended up around 7.25% today. So what happened this week? We had jobs data and the Fed meeting. Now, there are essentially two things the Fed has been focused on to try and get interest rates lower. That's inflation and jobs. So last week, we heard that inflation continues to be persistent and not coming down as quickly as the Fed would like. This week was all about jobs data and listening closely to what Fed Chairman Jerome Powell had to say after their two-day meetings this week. So why is the Fed focused on jobs? Well, a strong jobs market generally leads to inflation. People have jobs, they can spend money, while a soft job market can actually help curb inflation. Not as many jobs, not as many people spending. So they're also looking at wage growth and whether or not that is keeping up with inflation. So in other words, are workers making more money to pay the higher prices and pay their bills? So job growth missed expectations. The ADP jobs report actually came in a little bit higher than expected, but the Bureau of Labor Statistics, BLS jobs report, missed the mark. So previously, the month over month BLS report has been showing strong job growth. This was the first report in recent memory that it actually came in lower than expected. And we saw an increase in the unemployment rate from 3.8% to 3.9%. So that's ticking up. The Fed is looking for that to potentially go over 4%. Now, looking a little bit deeper into the reports and the methodology differences between the ADP and the BLS reports, it definitely appears the job market is softening, which should be good for inflation and interest rates. We could also see a scenario where the actual job numbers that were reported today were actually negative based on the differences in how the two reports calculate small business employment. So we're also seeing lower wage increases as well. That continues to tick down. One interesting fact is that the average number of hours of work has also been on the decline. In fact, it is almost at the same level of hours worked as it was back in 2011. Now, this is kind of hidden in the numbers, but can have a big impact on employees and their overall take-home pay to survive. So, while there have been some wage increases, employers are having their employees work less hours, which technically results in less take-home pay for many workers. The higher wages that everyone kind of sees may not actually be allowing the consumer to pay the higher prices because they're working less hours. So combined with this, I've talked about this many, many times. The consumer has been living high on the hog since COVID. Now, a lot of you don't think so, but the stimulus checks came in and they went, but the consumer kept spending. They didn't want to stop spending. They like spending. They like going out. They were racking up record levels of credit card debt. And I believe this has to come to roost in the not too distant future. They will have to start paying their credit cards off instead of going out to dinner or buying fun things. So not fun, but it's a reality. This will also slow the economy down as consumers will start spending money on interest, which is nothing, and not on the goods and services that they've been enjoying. So now that I've talked about the doom and gloom, what does this mean for interest rates in the real estate market? It could mean we are headed down in interest rates. And I believe that's going to definitely happen. It's going to go a slow trajectory. So while the Fed controls the cuts they make to the Fed funds rate, the mortgage-backed securities market, the quote Wall Street of mortgages, is driven and is market-driven and generally anticipates where the market will go. So based on the data that I see, and I believe Wall Street sees this as well, the economy is slowing down. They may try to get ahead of the curve right now and we'll start to see these interest rates get lower. If Wall Street can buy mortgage-backed securities now at a little bit higher return before the rates drop, that's how they will make their money in the long run. They may want to get in front of that curve. So in my opinion, this is a likely scenario, and we'll start seeing the rates generally decline from here. I can't stress enough for you to continue to engage or re-engage with your buyers. The Case-Shiller Home Price Index came out this week showing home values increased 7% in Las Vegas year over year, despite the elevated interest rates. And in San Diego, 11%. It's unbelievable. So those buyers that can qualify but are waiting until rates come down could lose out on significant wealth building by waiting. It's a lack of supply of homes, not interest rates, that are keeping the value strong. So as hard as it is to suck it up as a home buyer and pay a higher mortgage payment, more than what you really want to pay, the buyer basically needs to jump in and secure a home right now. So furthermore, they will almost assuredly have a refinance opportunity down the road to lower their payment in the future. This way they can lock in a lower home price and then get the home they want now and eventually get to the mortgage payment that they desire in the future. So it's going to suck, honestly, to have the higher mortgage payment for a while, but they will be rewarded in the long run when rates come down and they can refinance to the lower payment and their income is likely to go up in the future. So as always, feel free to reach out to me directly to get your buyers pre-approved and educated so they can make the right decision for them and they feel good about it. You can also send them to my calendar link where I can go through a free CIA analysis, credit, income, assets, so that they know where they stand now and what they need to do to get into a home. So let's run their numbers and get them into a home. Hope you have an awesome weekend, and we'll see you next week. This is Gaylord out. Bye-bye.